Happy Wednesday out there, folks. This is Darius Dale here to present our macro minute for Wednesday, June 22nd, 2022. Starting with asset markets, we have a full-blown deflation day. First deflation day we've seen in a while here. Asset market stocks down, commodities down, crypto down, dollar down, global bond yields down. It's going down. It's going down for real. Anyway, shifted our market moving headlines. Powell plus barbed wire around the Eccles building down there in DC. New barbed wire that they didn't have before equals Volcker. That's my back of the envelope side of the PowerPoint math here. So Jerome Powell may compound today's sour mood when he starts testifying before lawmakers today. He'll probably offer more details on the reasons behind last week's supersized move and may take the opportunity to issue some guidance on the criteria needed for a 50 or 75 basis point hike in July. He'll also face questions on the soundness of QE and probably some questions on what QT is likely to do to the economy and asset markets. He starts speaking today at 9:30 in Washington. He'll continue that as well tomorrow. I believe this is semi-annual testimony. Moving on, while we don't disagree with this view, this view would have been helpful in January, continuing with our theme of Wall Street coming out after the fact and telling you that there's a lot of risk economically. Odds of a global recession are nearing 50% per city. Central banks may pull off a soft or soft-ish landing, but that will require supply shocks to ebb and demand to remain resilient. Any recession may be a garden variety one in which unemployment rises several percentage points and output has a couple of weak quarters. Definitely don't disagree with that. We talked about that pretty consistently throughout the year in our leverage cycle analysis. Our leverage cycle analysis is one of the four pillars of our four horsemen of economic risks, of structural economic risks that we talk about in our macro scouting reports. But again, the time to talk about these risks was at the beginning of the year when guess who, which fat guy you know with gold glasses said, in January, I said this on the macro minute. Somebody go find that macro minute. And actually, no, I said it on the podcast, and then I started talking about it on the macro minute. I said, there's one thing we're not talking about today in January that we will be talking about by the end of the year, and this is the R word. It's recession. Obviously, everyone's obsessed with the R word today. Happened a lot sooner than I expected to happen, but certainly from a risk management perspective, certainly sitting pretty here. I think I'm up 8% following the old 42 macro portfolio construction year to date. Wish I could be up more, but hey, we'll take 8% when everybody else is down 40. The cycle, Trump's market microstructure whenever consensus offside. So my friend Chris Sidio and I had a great debate back in April about the evolving market microstructure and the sort of the structural shift in the volatility smile for things like the SPY in terms of favoring call skew as opposed to put skew. It still favors put skew on a net basis, but it really has shifted to favoring call skew. But I one thing I did leave him and leave the viewers with on that macro bundle Q&A discussion, which is, look, I think if we're right on the cycle, that's going to change. And so what we're seeing now is that actually changing real time. So trading in inverse ETFs, which when the market loses, is eclipsing activity in bullish leveraged products by the widest margin since the financial crisis per Bloomberg Intelligence. This looks like a fresh sign of disintegrating sentiment. Leverage long funds almost are always more popular than their bearish counterparts as retail traders seek to supercharge market gains. Now that the dip buying urge is evaporating, it is being replaced by demand for hedges amid this year's broad stock losses. And why is dip buying being replaced by demand for hedges? Why is perpetually bullish call skew being eviscerated? It's because of the cycle. The liquidity cycle's in a downturn. We flagged that towards the beginning of the year. The growth, actually, no, we flagged that going back to November. The growth cycle's in a downturn. We flagged that, going back to the middle of last year. Obviously, the inflation cycle upturn continues to surprise everyone's expectations to the upside. And oh, by the way, I still think we have a variant perception on the profit cycle downturn. You'll get our deep dive on that tomorrow in the Macro Voices. I had a great interview with Eric Townsend this week. So be on the lookout for that this Thursday. Big movers this morning. MSCI Emerging Market Index down 2% to down off 4% month over month. Bitcoin down another 2% to off 32% month over month. Ethereum down 3% to off 46% month over month. Bloomberg Industrial Metals Index down 3% to off 10% month over month. And WTI crude oil feeling the brunt of the unwind of consensus inflation positioning into what may be a pending or a developing market regime phase transition to deflation, down 7% to off 5% month over month. Shifting gears to volatility adjusted momentum signal and probable range processes. US dollar index, that's still bullish VAMs right in the middle of the range there. Gold, bearish VAMs right in the middle of its range there. 10-year nominal treasury yield is also in the middle of its range. High yield credit spreads breaking back out to bullish VAMs here this morning, closer to the upper bound of its probable range here with 70 basis points of downside, 13 basis points of upside. S&P 500 bearish VAMs close to the lower bound of its probable range with 2.1% of downside, 7.8% of upside to the upper boundary. Neutral VAMs VIX here, 25% of downside versus only 9% of upside. NASDAQ 100 bearish VAMs here with minus 4.2% of downside, 7.9% of upside. Russell 2000 bearish VAMs as well, closer to the lower bound of its probable range with 1.5% of downside versus 9.8% of upside. Bitcoin bearish VAMs had the little bounce off the lower boundary of the range. Now it's got a little bit more downside, 10% of downside to the lower boundary versus 25% of upside. To the upper boundary, Ethereum bearish VAMs here, similar situation, minus 17% of downside versus 32% of upside. Shanghai Composite neutral VAMs finally given a little breather, backing off the upper boundary of its probable range, kind of in the middle of its range now, 3.1% of downside versus 3.4% of upside. WTI crude oil bullish VAMs getting dumped like a getting who gets dumped well, like I don't know, you can dump people for all kinds of reasons, but this is a transition to deflation would be one of the best reasons to dump, to break up with what has obviously become a very consensus long. I mean, you listen to any podcast, everyone's biggest position, best long idea, both short term, medium term, and long term, is crude oil. If we go into deflation, this will be the thing that investor consensus sells really hard. They'll sell crude oil, they'll sell energy, they'll sell value, they'll sell all sorts of inflation bets across the physical commodity space and digital commodity space, by the way. Don't forget those are also inflation hedges. And then lastly, agricultural neutral VAMs oversold here with 7% of upside. I wouldn't be necessarily chasing that. This obviously looks like a chart that's having a topping process. Not guaranteed yet, but it's certainly we're in the process of maybe having these things go in motion. And then industrial metals bearish VAMs oversold with 9.6% of upside to the upper boundary of its probable range, which we're probably not going to get to anytime soon. So with that, Darius Dale presenting our macro minute for Wednesday, June 22nd, 2022. Best of luck out there today and next week. Cheers.